In today's video, I'm going to take you through a simple process you can follow to find undervalued REITs inside of thinkorswim. I'll be using the dividend discount model as my filter to determine what is truly undervalued. Now, step one is building a watch list of REITs that I care to dive deeper into. To help get this process started, I started with the built-in REIT watch list that thinkorswim makes available for you. If you come into the Scan tab and in the Scan In drop-down section, you look for REITs, that's the built-in REITs watch list that thinkorswim will create for you. Now inside of that watch list, you'll find both liquid and illiquid candidates. So to filter out those illiquid ones, I added a very simple average volume study filter here, saying, hey, filter out all of the candidates which don't have an average volume of at least 1 million shares per day. That narrowed our list down to just 82 REITs, which we could dive deeper into. Now, for those 82 REITs, I then applied our dividend discount model dashboard script to all 82 of those REITs. The discount rate that I used was 15%, and I used their last year's dividends to calculate what is the fair value price of whatever that particular stock is. For every place in which we have our current price is less than the fair value price, meaning the stock is undervalued, we have this green background, which makes it really easy to spot. For all Volatility Box members, I'll leave a link to this dashboard script in the description box below, so you can import it into your own platform and play around with it. It's included for free with your membership. Now, after we have all 7 of these candidates, we can group them into 2 different buckets. The first bucket is the mortgage REIT bucket. Here we have 4 different REITs that fit inside of this bucket out of the 7 that are undervalued. The remaining 3 are in the equity REITs bucket. Now for all 4 of these, the first 2 are ones which I imagine you might recognize, the second 2 not so much. Agency, our current close price, $9.32, but that fair value with the 15% discount rate is fairly close to where we're trading, a delta of just 3%. Armored Residential, very similar story here. The delta is just 4%. So we're close to what is the fair value price. You might be able to use something like selling puts for underneath to try and squeeze a little bit more premium out of this. Now the 2 which have this larger delta are of course the lesser known REITs on this list, IVR and ORC, which is Orchid Island. There the delta's larger, but also not as reliable in terms of dividend history compared to something like Agency. So Agency on this left side is the one that stands out to me just in terms of liquidity, along with familiar names, along with places where you can sell, say, the $9 put and still have enough of a delta to make it worth your while. Now we shift our attention to equity REITs. On this list, we have 3 different REITs that stand out. The first is Global Net Lease, which is GNL. Here that delta is 18%, so now we're starting to get a little bit wider. The second one is Medical Properties Trust, which I have an asterisk for, I'll talk about in just a second. There, our delta is even bigger, but we do have risk we need to factor in. Finally, this third stock on this list is Park Hotels PK, and there I wouldn't put a whole lot of weight on the fair value price, given that the dividend history of Park Hotels has been all over the place, which makes applying that DDM model not really all that appropriate for a REIT like PK. So there, I might just eliminate PK on this list for the fair value purpose, but PK out of the 7 is the one which has a market pulse stage of acceleration. So one reason it might still make your short list. Now another very interesting stock on this list, if you do like finding some of those falling knife opportunities, if you will, is Medical Properties Trust. Now there they have an ongoing issue of not collecting rent from some of their hospital tenants. To factor in for that risk, if you up that discount rate from 15% to say 25%, which I think is being fairly conservative here, but of course the full risk might be 100%, so 25 is still accounting for that risk, you get a new fair value calculation of $2.40 compared to the current fair value of $4. Now this $2.40 is very interesting because if you come into the options chain, for MPW, you'll find that $2.50 strike, you're still collecting right around $23 to $25, which represents nearly a 7.67% return. And that to me is a nice, interesting opportunity if you were trying to play something risky like medical properties in the first place. There, you're really banking on these dividends to continue and for medical properties to eventually collect this rent and for this issue to pass on over. On the flip side, if you wanted something that was, say, a little bit less on that risky side, you might come into something like agency. And there, if we're looking at, say, the $9 put, you collect a similar premium, but you'll notice that percentage return is much less, given that there's less risk involved. So hopefully through this video, you understood how we started with this large list of REITs. We narrowed that down to 82 liquid candidates, and from that 82, brought that down to a list of 7, broke that down into 2 different buckets, mortgage and equity REITs, and each one has candidates that stand out. You can, of course, dive a little bit deeper into each of these stocks and maybe tweak even these discount rates to be a little bit more appropriate for each specific company. I think that would be a good way to get a fair value that you have a little bit more confidence in and can use as your anchor point. Take care, everyone. Good luck trading, and I'll see you in our next update.